We're saying now you go back to 5,300 gold again, they're going to blow your head off. For silver, we think the key level is getting back over 90 again. If you want to know when this quote correction is over with, which has really been a violent sideways consolidation if you look at it, you better cover your shorts. You saw in late January to be the midpoint correction. Time-wise, I think silver could be $300 to $500. So they're saying, hey, buy silver and buy the miners. Yes, gold is the mama, but we're going to outperform the mama market within the complex. I think we're now in the process of resuming the upside. There's a point at which, like you said, we've dumped a lot of people here. And that's fine, because a lot of these people were late comers. And you get up to 53, 5,400, there was one spike above 55. But basically, at 3 months, pounding the same level. Gold doesn't peak that way. You're going to have a blood flow. And already some smart money's been moving into what? Not T-bonds, gold and silver. You'll have a massive money flow out of that broken bubble into gold and silver. And the central bank will go berserk. The new Fed chair is going to go berserk. What these charts show is simple. It shows gold miners, and silver plotted in their relationship to, their valuation comparison to the S&P 500. And these charts go back to 2008. And as you can see on the left side of each of these charts, its high levels were reached in 2008 through 11. And that's when gold peaked. Remember, in that price, it peaked in late 2011. So did its spread relationship to the S&P. So did silver, so did the gold miners versus the S&P. They not only dropped in net price, but they dropped in relative value to the S&P.
Right.
So the spreads collapsed. Okay. And the spreads collapsed down through 2015 and even a little bit lower, a little later, as the market themselves dropped. Gold miners, silver. Okay. But then over the last, like 10 years, these charts effectively went sideways, meaning they were holding their value. Whereas if you randomly bought gold miners or gold or silver, like say 8, 9, 10 years ago, where these spreads are right now, you're actually making money.
Yeah.
Versus the stock market. Nobody believes that, but you've been making money and holding your own all during that time, meaning as the stock market advanced, so did gold and silver. So they weren't really a worse place to be. They didn't have any headlines. Stock market always has the headlines.
The real story here isn't price. It's what quietly held up while everyone chased tech headlines. As Michael Oliver points out here, these spread charts show gold and silver didn't collapse after 2011. They stabilized relative to the S&P 500 for nearly a decade. That's a major disconnect from the narrative that metals did nothing, especially as equities surge post-2020 liquidity injections. If assets hold relative value during a historic bull run in stocks, it signals underlying strength institutions rarely advertise. Most investors miss that because performance wasn't flashy, just steady. Next, Michael Oliver shows why this quiet base may be the setup for something much bigger.
But from a long-term investment point of view, these charts are all echoing the same statement. They're saying, hey, we're now beating monetary metals, and the miners thereof are beating the stock market. And this is a fresh major base breakout in all three cases. Their performance just shifted back in November. So when you have a base that's more than 10 years wide, let's say this is a price chart, and somebody flipped it on your desk and said, should I buy this? You say, heck yes, that's a fresh breakout. So what these spread charts are all saying is, one, I built a major base that said, I'm not going any lower, step one. Step two, the base is huge, it's clear, it's definable. You just broke out in November. These, Jan, Feb, March, 4 months old, and the spread is not that far off the breakout level. Far enough to be noticeable, but still, it's not overdone. It's not aged. There's nothing about these charts that says anything but buy me relative to the stock market. And it just began. It's just the opposite of what happened back in 2008 through 11. You could see the spreads were topping. And anyway, so now we've bottomed freshly. This thing's going up. These markets are going to beat the stock market over the next several years.
Right.
And it just began. So it's not overheated like everybody claims.
This is where the narrative flips, but almost no one on Wall Street is saying it out loud. As Michael Oliver points out here, a 10-plus year base breakout isn't just technical noise, it's a structural shift in capital flows. These formations rarely fail because they represent years of suppressed relative performance finally reversing, especially after November's breakout window. Yet mainstream coverage still treats metals as late cycle trades, ignoring that this move is only months old. When something just breaks out after a decade, it's early, not crowded. Next, Michael Oliver discusses why this move may still be far from overheated.
And now look at the drop you see on each of those charts. That's where we were as of Friday. Okay, gold versus S&P, gold miners versus S&P, silver versus S&P. Hardly noticeable. Not the kind of drop that would say this chart is negated. No, it's just a little hiccup.
Yep.
Okay, so this is what investors should be looking at.
Yeah. And also, I might add you, and I don't want to put words in your mouth. I saw this opportunity. I actually sold, I own a lot of miners, okay? I own a lot of miners, but I was selling into the strength just because of my expectation that
Yeah,
and this is my trader hat. If you're a trader, I just
that's
like
fine.
it's really getting hot, if you would, and then everybody's on one side of it, and there's a lot of headlines about gold and silver and the miners, and then it made me scared, it made me weary. But then this recent correction, I'll call it a correction, and again, this is just what markets do, and I just want you to chime out. It got a lot of people out and everybody questioning. You kind of want that. Correct me if I'm wrong,
Yeah,
Michael, in a market. Just
yeah.
unless and it behoves those people that keep their wits and also keep their emotions in check and just really follow the charts, because the charts, just your charts, paint
Yeah.
such a beautiful picture. So, but yeah, go ahead.
No,
That scary drop everyone reacted to barely registers on a long-term chart. As Michael Oliver points out here, the recent pullback in gold, silver, and miners versus the S&P is structurally insignificant, more noise than signal. Yet sentiment flipped fast, showing how fragile positioning becomes when headlines get crowded and everyone leans one way. This is classic shakeout behavior. Weak hands exit, stronger capital resets at better levels. For investors, this is where discipline matters, not emotion. If nothing broke technically, then the trend likely didn't either. Next, Michael Oliver talks about why corrections like this are often necessary inside major uptrends.
absolutely. We thought that breakout in November, by the way, on these spread charts, relative performance, is our final buy signal for gold now and silver and the miners. We put out long-term buy signals in 2024, April, March, April of 2024. At that point, silver, for example, was pushing up toward 26. Okay. Uh, and the golds and miners were much lower levels than they are now. We put out another buy signal in June of 25. And we're talking silver, especially here. And November of last year was our final major last point of entry. Okay. So if you're joining now, you're late. We're not going to offer major entry points now. We'll offer short-term entry points. But the big signals have already been rendered, this being the last one that you're looking at there. So the issue is, okay, what are we expecting out of this big shift?
Yeah.
And we're expecting a explosive acceleration move in the whole complex.
I
But
agree.
we've been arguing all along that somewhere in the middle of this clock, and we think the clock is like a couple quarters, meaning starting December, so early summer, let's say. Much of the dramatic part of the price move should occur. It happened sooner than we thought. We thought there would be a midpoint correction. Therefore, we were kind of thinking maybe April. Instead, it happened the end of January. So we're fooled, yes.
The uncomfortable truth is the biggest money is made before the crowd even realizes there's a trend. As Michael Oliver points out here, key buy signals were already triggered across 2024 and mid-2025, with November marking the final major entry. That means today's investors aren't early, they're reacting after confirmation when risk-reward shifts. This acceleration phase often compresses gains into short windows, which is why timing matters more than conviction alone. Markets don't wait for consensus. They punish late entries. Next, Michael Oliver shows why this phase could now transition into a much faster move higher.
But we still regard this, when we look at our long-term momentum charts and even these spread charts, There's nothing being broken here. You're just
Yeah.
having a sharp sell-off.
Right.
And therefore, it's a sell-off within an uptrend. And it's a buying opportunity for those who didn't buy at our buy points. Like if
Yep.
you average our last three buy points in silver, the average price of those 3 points of entry was $36 an ounce.
Mhm.
Okay,
Right.
so we're trading 72 as we speak. Okay, so well, should I be crying? Okay, I don't know. Anyway, we think that what you saw at the end of January, by the way, which took a day and a half, it was
Right.
really one day, January 30th, and a half a day on the opening of February. Almost all the break had occurred by then.
Yep.
And last week we went down and nipped out those two lows, the low on gold that had occurred then and the low on silver that had occurred then. We stayed below those lows for 2 hours. This is early last week. And then said whoosh, right back above them and said, I don't belong down there. Okay. That was the final cleansing poke. Okay. I think we're now in the process of resuming the upside. There's
Yep.
a point at which, like you said, we've dumped a lot of people here. And
Mhm.
that's fine because a lot of these people were late comers.
A 50% move followed by a sharp shakeout isn't weakness. It's how strong trends reset. As Michael Oliver points out here, silver doubling from $36 to $72 while holding structure tells you momentum hasn't broken, just flushed out late buyers. The January 30th drop, compressed into barely 36 hours, looks more like forced liquidation than a trend reversal. Markets often stage these cleansing moves to remove crowded positioning before continuing higher. The danger isn't the correction, it's misreading it and exiting too early. Next, Michael Oliver unravels why this reset could mark the start of the next leg up.
They didn't buy at $36 silver or $25 silver or uh, where silver was in November when it broke out on this spread versus the S&P and also versus gold it did. Silver was then 56. Okay.
Mhm.
So this move, this jiggle we're seeing is what we think is middle of the clock, basically, of what we thought would take 2 quarters. Okay, December, January, February. Okay, now we're in March. Okay, April, May. I think by summer, if we see this short-term turn up that we're seeing right now continue just a little bit more, we're going to get some breakouts on short-term stuff that say, yep, going back up again. Okay. Now, where is the public going to wake up? Flip the page. Let's see if we
Yep.
can, if the
About,
chart's
about
there.
all that, Michael, and I'll just talk to my viewers and listeners. Number one, I love just a trader hat. I love pain. I love,
Yeah.
but I love pain, but it has to be, but it's just can't be just pain. It has to be in a structure, if you would. It has to be technically speaking. That's what you're showing us. It has to be also held within a structure, technically
Yeah, if
speaking.
this break had broken something on long-term momentum of silver, gold, or the miners, we'd be bearish.
Right.
We turned bearish on gold 2 months after its high in 2011 and stayed bearish till 2016, February of 2016, because
Mhm.
long-term momentum had broken.
Timing the market feels chaotic until you realize most of the move already happened before the headlines caught up. As Michael Oliver points out here, the so-called mid-cycle shakeout is happening months after silver already doubled from key entry zones, which means late buyers are reacting, not positioning. This idea of a two-quarter move compressing faster suggests liquidity and momentum are stronger than expected, not weaker. Historically, when phases accelerate like this, retail participation arrives late and pays the price. For investors, the real question is whether you're early in structure or late in sentiment. Next, Michael Oliver discusses why structure matters more than short-term pain.
Right now, this break in gold and silver that we had didn't break any long-term metrics.
Right.
It broke short-term stuff. Yeah, you can
Sure.
always do that, but then those can heal quickly.
Mhm.
But anyway, this is within the complex. Silver versus gold is the top left chart, and this is the one we're mainly focused on. Silver is very cheap in relation to gold. It's a little bit more than 1% of the value of gold there, or 1.5%, excuse me. Uh, and we think it's going to go to 3 to 6%. It's like look at the 2011 high on that chart there. It got up over 3%. Divide an ounce of silver into an ounce of gold, it was 3% plus. Right now we're above one. It's still cheap versus gold. And it is a monetary metal.
Mhm.
Don't let thousands of years of history go by. It's a
Yeah.
monetary metal. And the same thing's going on with the miners, the XAU index versus gold down below, and the Huey versus gold. They both broke out of relative performance situations too. So they're saying, hey, buy silver and buy the miners. Yes, gold is the mama, but we're going to outperform the mama market
Yep.
within the
Yeah.
complex. Now look at the gold chart below. Go to the next page. Just simple, stupid price chart. Okay.
The market is quietly telling you silver is still undervalued, but most investors are too focused on gold's headline highs to notice. As Michael Oliver points out here, silver sitting near just 1 to 1.5% of gold's value versus historical peaks above 3% signals a major relative mispricing. The gap isn't just technical, it reflects capital not yet fully rotating into higher beta metals. Meanwhile, miners breaking out against gold adds another layer institutions aren't emphasizing publicly. When multiple relative charts align like this, it's rarely random, it's positioning ahead of a shift. Next, Michael Oliver shows why this relative value gap could close aggressively.
Well, we're higher than that right now. In fact, if you factor in that we're rotating to June gold, then we're well above that last reading. But there's 3 months up there effectively stalled at the same price level. You get up to 53, 5,400. There was one spike above 55, but basically, at 3 months pounding the same level. Gold doesn't peak that way. If you go back to 2011, when you made your high in September, I think it was 2011, you dropped from 1900 down into like the 1500s. You never
Hmm.
came back anywhere close to the 1920 price high.
Hmm.
You came up into the 1700s again, but you couldn't get back up to the old high. Well, if
Hmm.
you internally look at gold on a daily chart, anybody who's watching this right now, go to your quote screen, punch up a daily continuation of gold. You'll see that the peak daily close back in late January was just above 5,300.
Hmm.
Early this month, we had a peak daily close just above 5,300. In other words, not only does monthly price chart go back up into that supposed thin air, but the daily price close went back up and effectively matched the peak close of January.
Repeatedly revisiting highs isn't weakness, it's something far more dangerous for short sellers. As Michael Oliver points out here, gold holding near peak levels for 3 straight months while matching prior daily closes suggests accumulation, not exhaustion. Compare that to 2011, where price failed to retest highs after the initial drop. This structure is fundamentally different. When markets refuse to break down, despite pressure, it usually means stronger hands are absorbing supply quietly. For investors, this reduces downside risk but increases breakout potential if resistance finally gives way. Next, Michael Oliver talks about what happens if those highs break decisively.
In other words, the air is not as thin as you think up here. You shouldn't have been able to go back to the high again. We're saying now you go back to 5,300 gold again, they're going to blow your head off.
Yeah.
And for silver, we think the key level is getting back over 90 again. And we're talking price now, not
Yeah.
momentum will give you earlier signals. And those are in our reports. But for just a price chart guy, if you want to know when this quote correction is over with, which has really been a violent sideways consolidation if you look at it. You get back over 90 on silver and you get gold to 5,300. You better cover your shorts, uh, uh, or you're going to wet them because they're going to blow at that point, and
Yeah.
you're going to get the acceleration that we expected in this couple quarter surge. And consider what you saw in late January to be the midpoint correction.
Got it.
Time wise. I think silver could be $300 to $500.
That's
You
a
get back,
beautiful thing.
serious. Yes, no. And the factors in play are both the monetary aspect, because if during that same time we see those S&P charts, one, have a little bounce now, waste some of late March, early April, maybe a
Hmm.
couple weeks here, have a nice rally.
Key price levels don't just matter. They trigger forced moves most investors underestimate. As Michael Oliver points out here, reclaiming 5,300 in gold and 90 in silver could ignite a short squeeze dynamic, not just a breakout. These levels act as pressure points where bearish positioning gets unwound quickly, often accelerating trends beyond expectations. The idea of silver reaching $300 to $500 sounds extreme, but parabolic phases often follow long consolidations when liquidity shifts. Investors should focus less on prediction and more on recognizing trigger zones. Next, Michael Oliver unravels how broader market conditions could fuel this surge.
Because the Iran thing abates or whatever. And then you roll back through those annual and quarterly structures we showed.
Mm-hmm.
You're going to have a blood flow. And already some smart money's been moving into what? Not T-bonds.
Yep.
Gold and silver.
Gold and silver.
Okay. You'll have a massive money flow out of that broken bubble into gold and silver once it becomes a public awareness that, oh my gosh, it's really broken.
Yep.
And the central bank will go berserk. And we already know, the new Fed chair is going to go berserk.
The real catalyst isn't geopolitics. It's where capital runs when confidence in equities cracks. As Michael Oliver points out here, the shift into gold and silver isn't random. It's early stage smart money positioning ahead of a broader rotation. If equity markets roll over after Q1 rallies, liquidity doesn't disappear. It relocates, often violently, into hard assets. Central banks reacting aggressively only amplifies this by injecting more liquidity into already tightening supply dynamics. For investors, this isn't about panic, it's about tracking where money flows next.